Companies Act. A special presentation by The Firm.
The one big distinction between the new Companies Act and the old one is the inclusion of private companies. The Companies Act 1956 exempted private companies from many provisions. The Companies Act 2013 covers private companies in most provisions. The new private placement norms apply to private companies. The restriction on intercorporate loans and investments apply to private companies as well. Private companies with a paid-up share capital of 20 crore rupees and more must rotate their auditors. And the extensive disclosures on related party transactions, as well as the restrictions on RPTs that apply to public and public listed companies also apply to private companies. Now, at the time of designing the law, the Ministry for Corporate Affairs, in its reasoning with the Parliamentary Standing Committee, said it preferred to rely on the power to exempt to provide future exemptions than exempt private companies right at the start. Well, it's been barely 3 months of the law going live, and a long list of exemptions is already on the anvil. Will they offer substantial relief to private companies or not? On Companies Act this week, I have with me Ashwath and Venkateshwaran. Gentlemen, to both of you, a very warm welcome. I'm going to go back to the reasoning that the Ministry provided to the Parliamentary Standing Committee for your opening comments on the impact of this Act on private companies. They said we'd rather use the power to exempt, to give relief to private companies in certain situations, as opposed to exempt them right in the very beginning in the law itself. Would you say that was the right approach when it came to private companies? Because we are now 3 months into the law, and many private companies are weeping.
Purely from a legislative perspective, I think it would have been better had they done what they did in the 1956 Act, which is looked at it provision by provision and decided what was the public purpose that was sought to be achieved by each provision and decided whether it needed to apply to private companies or not. The certain class of companies provision that is there was there in the previous statute as well. The intention for that particular provision is entirely different from basically exempting the primary classes of companies.
Exactly,
it's meant to be, sick companies and
right, and also in extraordinary situations or
Absolutely.
circumstances where you realize something is having an unintended impact, you can exempt the companies from that then.
Absolutely, and the fact that that was not the way to do it is only being proven by the current exercise that is underway to try and now claw back and restore some of the benefits that were hitherto there. Many things are getting missed out, and we'll talk about it, during the course of this show.
It's weird because it gives them flexibility, Sai, that they can use the power to exempt now, to exempt classes, though that may not have been the intention. But it also creates for a lot of flux. Like, even as we go through this conversation, there will be so much of if this becomes, the law, or if this changes. And this could continuously change. As we've seen in the last 3 months, there are circulars out every day changing positions on provisions.
Private companies are struggling since 1st of April when these sections became effective. And today we are sitting on a draft circular which has apparently been tabled in both Houses of Parliament. But I doubt it'll see light of the day in the current session or next month, and it'll probably get finalized only when Parliament kind of meets again, probably in the winter session. So that means for another 6-8 months, private companies are going to have to deal with all of the challenges, and then only kind of...
so half a year, actually, a fiscal year will have passed.
Absolutely.
Before we get certainty on what applies to them and what doesn't.
Absolutely, and ideally they should have thought through what are the issues that private companies will face, and before they made it effective, I think come out with these exemptions, rather than having them go through all of this pain and uncertainty for a number of months and then kind of withdraw some of these.
All right, point well taken. Let's look at the various areas of impact and try and understand what this means for private companies. Fundraising for private companies has become tougher on account of 2 or 3 different things, some which have been attempted to be rectified in the draft notification. For instance, the raising of deposits, there are new restrictions. Issuing shares with differential voting rights, you need to have a profit track record. That would be very difficult for a young startup company to have. And thirdly, when it comes to private placements, the restrictions that apply on private placements and preferential allotments for public and public listed companies apply to private companies as well. Why is this painful for private companies, and will it mean that they are not able to raise capital with the ease that they were able to under the 1956 Act?
As far as deposits is concerned, Menaka, my own view is that it's probably more relevant for the bigger public companies. Now they've, in the rules basically, or rather the notification, they've eased it for private companies as well, subject to certain limits. So I think they've addressed that partially.
So only companies with 50 members and less. Can avail
and that's been modified in the July version. We'll come to which version is correct.
Because there is yet another version out there, which is purportedly the version that's been placed in front of Parliament, and nobody's sure whether it is or not. Right?
And they've removed the 50-member limit there. And they've only
so all private companies have then been exempt from the restrictions on deposits?
Subject to certain limits, which is basically twice the capital or 50 crores, whichever is lower.
Okay, fine.
But I think the two other points that you raised are actually the critical ones. The fact that the 2013 Act effectively made it impossible for a private company to issue different shares with differential rights was something that actually impeded a lot of structures, both domestic and foreign.
Right.
Because you had waterfall mechanisms in terms of promote structures, etc., where economics were differently shared between different shareholders in the company. And there was no reason why you needed to actually restrict that in the context of a private limited company.
Yeah.
The June draft itself eases that. So differential rights are possible. So I think that's a positive.
Yeah.
I think the problem with the 2013 Act, which applies to all companies and is particularly onerous in the context of private companies because the rationale for applying this set of restrictions is a little more unclear than in the context of public companies. It's basically this whole confusion about whether every preferential allotment has to follow private placement rules. Now, it is very clear conceptually that every private placement of shares will result ultimately in a preferential allotment for the issuance to take place.
Right.
But not every preferential allotment need necessarily follow a private placement process. The whole concept of a private placement, this is obviously to address the entire Sahara problem, is to basically say that, look, don't try and overcome limitations on publicly raising money by using the private placement route and converting what is effectively a private exercise into a backdoor public fundraising exercise. So they've come out with, rightly, limits on what you can and cannot do in a private placement to retain the private.
And actually they've been fairly lauded, those limits, because they've put in some well thought through safeguards, so to speak.
Absolutely. But now if you take a situation where there's an existing shareholder of the company who wants to contribute capital and they're not doing it through a rights issuance, or there is a single private equity investor that you're talking to and you're going to make a private preferential allotment of shares to that particular investor, the confusion now is as to whether you need to comply with the private placement norms. Even though it's a one-on-one arrangement, you're not really going out in the marketplace and talking to 50 people or 200 people as the case may be. Even then, now because of the language of the statute as it stands right now, the safer view, which a lot of the market is following, is actually to follow the private placement norms.
But those are fairly extensive norms, as you pointed out.
Extensive norms, and Menaka, the whole idea of having a private company is to do things privately, right? And things like confidentiality, etc., are protected. Now you're in a situation where, even in a private company, you have to disclose the identity of the investor, the number of shares that the investor is subscribing, most importantly, the price per share, therefore divulging details of valuation. There is no logical policy reason for wanting to have all of that in the public domain, and unfortunately misuse is a reality in this particular market, and that's a big concern, a big dampener.
I think they should probably just exempt private companies from some of these requirements.
But that's not available in the draft notification, at least from what I understood, is it?
I don't think
there's no relief from these provisions in the draft notification.
There's no relief specifically on these provisions, and maybe that's something that they should consider in the next round.
Without which, what happens?
Earlier, a private company, through a board approval, could go and do a preferential allotment to a new investor coming in. Now they have to go and take shareholder approval and take a special resolution from shareholders.
But is this really a deal breaker? My point is that, it's a little bit more painful.
It's more cumbersome. I think
is any of this a deal breaker?
The resolution is paperwork, but having to follow private placement norms, to my mind, is clearly a deal breaker.
Why is that?
Why would
outside of the confidentiality issues that you've raised,
which is a big deal.
All this gets filed with the ROC. Who's going to be able to get the information out?
I mean, from experience, a lot of people.
So you're saying that is a deal breaker for sure?
Of course it is.
Companies Act, a special presentation by The Firm.
The other key talking point seems to be the new governance requirements side, which seemingly are too onerous for private companies. Within that, the sub-points to that are, for instance, auditor rotation applies to all companies, including private companies of a certain size and more. Sections 185 and 186, which are restrictions on the loans that you can give to directors or to other companies, they apply to private companies. 188, which is the dreaded related party transactions section, that applies to private companies. And then the insider trading section, also applies to private companies, which is the most befuddling of them all, because there's no public traded price in this. So why would it apply to private companies? All of this making life very difficult. What would you pick amongst these is the most material negative impacts on private companies?
I think I think each one of these has its own set of impacts. So if you look at 185, 186, I think just the ability of funding within their own corporate structures, I think that's kind of almost come to a standstill. Although there are now limited exemptions that are available.
So in the draft notification, right? What exactly have they suggested in 185? They've said that if there is no body corporate shareholder in that private company, then 185 does not apply. Is that correct?
Yeah.
Yeah,
And again,
sorry,
I
you
think
wanted to add
they put a
something
limit as well.
Take your pick.
Yeah.
June says what you just said, but the
And
July
the July
draft
says
which we don't
exactly the
know
opposite.
if it's an
The
official
July draft is the question mark draft,
This is the
because this is
question
some
mark
one
one.
website that has this draft,
Yeah.
and it's not been put out by the MCA in any fashion.
No, it hasn't.
Okay.
Yeah. So effectively, if you look at what the July draft says, which is the more recent one,
Right.
and let's go with it as a later version for a second.
Okay.
It basically says that if you don't have loans from banks, which is in excess of 2 times your capital or 50 crores, whichever is lower, you have a body corporate shareholder. That's a change from the
So
June
you have to
draft.
have both. You have to meet both these conditions.
And you're not in default of your debt.
Then 185,
doesn't
186
apply
don't
to
apply, or
No,
only
only
185?
185 doesn't
So
apply.
186 continues to apply on all
186,
private
yes,
companies.
absolutely.
So the ability to extend loans within that group become painful, or even outside
So
the group,
186,
actually.
yeah, it's again a question of getting a resolution done to kind of exceed your 60% or 100% limit.
Right.
So that's not so much of an issue. But I think the challenge that a lot of companies are facing is that even under 186, you still got to charge that whatever your
Yeah,
bank
the
rate of
bank rate,
interest.
Hmm.
I think that becomes a challenge, especially when you're funding another entity which is not doing so well, or maybe a startup, etc., to then be expecting them to charge interest, and you're
So I think
booking
that's
interest, yeah.
subsection 7 or something, which says
Absolutely.
that if you're putting out a loan under this
Yeah,
provision,
yeah.
it must be at a rate that's above the bank rate
Bank
for
rate,
that
absolutely.
comparable tenure of some sort. The
Absolutely.
government rate, actually.
Government
the
rate,
government
yeah,
security
the GSEC
yield.
rate.
Yeah.
So 185 talks of, I think, the bank rate, and 186 talks of the GSEC rates.
Okay,
for
so
a
that's
similar
going to be the
tenure.
key pain point
I
for
think
private companies
that's
on
one
that.
pain point. I think the related party transactions is another one which, if you go by the June notification, I think they're giving total exemption, which I think is good. I think the July one also, I think, brings in some relief. It I think, makes two changes. One is it narrows down the definition of related party in the context of a private company by saying that other entities in the group, that is your holding company, subsidiary, associate, all of those entities are no more considered your related party. That's one. Second is it's
But that only applies to a private company.
only to a private company.
okay.
And second is in terms of the members who are allowed to vote on a transaction that needs to be taken to shareholders. It for companies in general, like an interested shareholder cannot
vote,
but
yes.
for private companies, even an interested shareholder can vote on it.
So those are the only two reliefs in the July. Not very sure about this notification,
Yeah,
that's
right?
In
Through.
the June notification,
They've said it's
full
a
exemption.
Full exemption.
Section 188 does not
Does
apply
not
to private companies at all,
absolutely.
right?
Actually, I think the July position as far as related party transactions is actually the better position. If you really look at it from a governance perspective.
Wouldn't you prefer a complete exemption?
Menka, I think depends on which perspective, right? If you're a promoter of an Indian private company, you'd clearly prefer the June draft. But if you were to say, for example, look at it from a private equity perspective, right? A private equity are paranoid, particularly in our country, about this particular category more than anything else. They're really worried about related party transactions. Look at, what Sai said. There are two conditions, two relaxations that have come through in the July draft. One, they've said group companies, right? If it's in the same group, no problem, right? Which is helpful. And the second is they've given the related party a right to vote. They've said that the related party can still vote, right?
Yeah.
So I think the promoters got less reason to complain. And there is some degree of protection given to a third-party investor, even in a private company, because it says that you have to go through that particular governance process. So I wouldn't rate the RPT provision as cumbersome or obstructive as, for example, the 185 and 186 problem.
Okay, insider trading applies to private companies, and how in heavens is anybody going to sort of enforce that?
Menka, again, as with many other provisions of the Companies Act, this is not free from doubt, but at least the view I hold is that the insider trading provision, 195, does not apply to private companies. It comes out of the fact that the reference in 195 is to securities, and securities is the definition under the SERA. And SERA ultimately, there's case law to clarify that the shares of a private company is not a security for the purposes of the SERA because it's not marketable. So insider trading, I don't think is the problem. For private companies, the much bigger problem is 194, which is the prohibition on forward dealing. So, we've had sessions on this very show in relation to, put call options, etc. And SEBI and RBI have been really good in clearing the decks and clearing the ambiguity. But the Companies Act has done us a bad turn there because the ambiguity continues thanks to the fact that 194, in my view, actually applies to private companies, even private companies.
Yeah.
So if the person who is party to your put or call is the promoter of the company who also happens to be a director, which is not at all unusual, then he potentially faces imprisonment.
If he was to enter that put and call option.
And this was not, as I think we were discussing earlier, this was not the objective at all. The idea was to prevent people, employees of the company or managers of the company, from taking positions in the stock
markets,
Correct,
and the derivative markets, the listed derivative markets, so to speak. So is this hurting the ability of, let's say, promoters? Because it's a very common instance, if I've understood this correctly, in private companies where you have private equity investments and the promoter does sign these option agreements to give the private equity investor some sort of assurance that, look, at some point in time, if you want to exit and you can't go public or we can't go public, etc., I'm willing to buy back your shares. He can no longer enter that kind of an agreement.
There are interpretations around this. I think one of those interpretations are that if you look at the way the forward dealing prohibition is written, it also speaks of a fixed price. So in any event, fixed price returns are illegal for a different set of reasons, particularly in the cross-border context. So one way that people are getting out of it, or at least believe that they're getting out of it, is to have an FMV related put or call. So at the end of the day,
which is exactly what anyway SEBI and RBI wants in the case of listed and public companies, for that matter.
That is right.
So you just follow that same principle for all companies, whether it's private, public listed, and you're probably safe.
You're probably safe.
I want to talk about wrap-up comments because we're at the end of the show. What does all of this mean for private companies? Is it, does it become almost purposeless for you to be a private company as opposed to being a public company, because you stand to gain nothing? There are no exemptions. You're doing pretty much everything that a public company has to do in terms of compliance, etc.
In fact, a lot of private companies that I have interacted with in the last few months, several of them have realistically started considering moving to an LLP structure. Simply because they don't see an advantage being a private limited company and having to go through all of these cumbersome compliances, and at the same time the increased kind of risk and the penalties, etc., that they're exposed to. So I think realistically a lot of them are evaluating moving to a LLP structure. The only thing that they want clarity on is tax neutrality when they do that. And in fact, one of the recommendations that went to the finance minister before the budget was to actually allow a tax neutral transfer from a private limited company to an LLP.
And that's not yet come through.
That's not yet come through.
I think the current position from a tax perspective any which way favors an LLP. But that's not the reason why you haven't had a entire migration from private companies to LLPs. Why hasn't it happened? And I think it's worth thinking about that. Firstly, I'm a lot more optimistic about the fact that you're not going to have any mad rush, simply because of the fact that I think whether it's a June or July notification, one will have to wait and see, has eased some of the problems that came with the 2013 Act. They haven't cured all the problems by any stretch of imagination, but they've done a decent job. So clients are going to be a little happier for that. But please understand what the impediment is to actually move to an NLP. An NLP is untested. Ultimately, an entity which does business has to interact with the whole set of laws, right? It can't function in isolation. And if those laws don't recognize an LLP, for example, you go for an NBFC registration and the RBI says, what NBFC, right?
What
LLP? Or for that matter, if you have, for example, foreign investment, and foreign investment is under the automatic route only for companies, it's just a lot of effort that goes into getting the attendant statutes to actually, change to recognize an LLP, and then the cost of doing business in between. I mean, we've had real estate clients actually consider it and basically says, we see it as a serious problem because there are a number of municipality and other regulations that don't recognize an LLP.
Yeah, fair enough. Okay, so you're saying you might not see the rush to LLPs happen. Then my final question to you is not about whether there will be a rush, but what else is left to deal with besides what has been dealt with by the draft notification of June and the so-called final notification of July?
So, the one
if
point...
If the MCA is listening, what would you tell them to fix, Ashwath?
What they did was, they looked at, what exemptions were available under the 1956 Act, which, were not given in the 2013 Act, and then they've come out with this, exemption list under the notification, trying to plug part of what was missed out. But I think what they haven't realized is that the 2013 Act actually has a lot of new concepts that have been, either advertently or inadvertently applied to private companies. So, for example, the definition of a listed company under the 2013 Act is any company which has got its securities listed. So, any private company which has issued NCDs, right, is going to be treated as a listed company on par from a Companies Act point of view to a company which has got its equity shares listed on a stock exchange. And all those onerous requirements would apply. CSR is a concept. The 2-layer limit on investment layers, you know, policy justification for public companies, anything, you know, to justify it for private companies. The requirement for resident directors for private companies is going to be a problem for a lot of our foreign clients who actually have private company operations over here.
Okay.
I think you also need to look at a lot of the additional governance and kind of reporting requirements that actually now become applicable to private companies as a result of this. So be it on the internal financial controls or be it on the director's responsibilities around compliance with all laws and regulations and demonstrating a process for all of that. One other point which I think the MCA in their drafting of this June's notification on the auditor's appointment, where they've tried to deal with the 20 company limit, but I don't think they've got that fixed right. And the reason being, this notification will only be read in the context of a private company. So when a private company is looking to appoint auditors, he can disregard whether the limit of 20
but
is
the auditor can't disregard because in the auditor sections it's not been relaxed.
Absolutely. And
but public that's a pain point for auditors.
No. And for public companies. So for a public company, when they are looking to appoint auditors, so they only get to see that if the auditor is holding appointment of 20 companies, then he can't appoint them. And that could be 20 private companies that he's holding appointment in.
And don't worry.
Quite absolutely the last one, since we're at the end.
The July one makes it worse as well, because they've not any which way said it's exempt from the 20 limit if it's a private company. It has to be a private company and it has to have a share capital of less than 100 crores.
Yes, they've put in a new size requirement there. Absolutely. All right, gentlemen, thank you very much for vividly describing the various pain points that private companies are currently facing. Thanks very much for being on this edition of Companies Act, and thank you very much for watching.
Companies Act, a special presentation by The Firm.